When Bay Street and Wall Street look at the streaming companies in particular, they see a business that grew over 30 years on large transactions, and they believe that the large transactions are over, and that's wrong. The large transactions are increasing, and I'll tell you why. Uh, Gold and silver cash flow in a royalty or streaming wrapper trades in the market at 14 or 15 times cash flow. Base metals cash flow as part of a producing company changes hands at 5 or 6 times cash flow. What that means is that the gold and silver byproduct from a copper mine is best owned by a royalty and streaming company. A royalty and streaming company can pay a disproportionate amount for that portion of the mine's revenue that comes from gold and silver rather relative to copper. The copper industry estimates, and I just heard this number in London, it surprised me. The copper industry estimates that they will need to spend $250 billion in the next 10 years to maintain current production in a market where demand is increasing at 3% compounded. In those three circumstances, the financing of base metals projects, private sector M&A, and public sector M&A, I think that the opportunities available to the streaming industry dwarf the opportunities that we've seen over the last 30 years.
You mentioned that when you were taking some profits off the table, you were trading some alpha for beta, and this have to do with the equities. And so I do want to kind of go through some of the royalty and streaming companies as you rank many portfolios, and there's many levels to this. And so I know you're a big fan of like Wheaton and Franco-Nevada and such. And so I want to start with just some of your rankings on some of these companies because they do mitigate a lot of risk. They do trade at a premium. And before we even get into the actual companies, there's this perspective that there's little to no growth in this particular sector. And so I want to get your thoughts there because I know that many of these companies have a lot of exploration projects that aren't producing assets yet. And so I want to get your perspective there.
Well, you made two great points there, Daryl. The first is that royalty and streaming companies are lower risk alternatives to exploration producing companies. The structure of the business is that you don't have a direct interest in the gold or silver mine, which means that you're not responsible for the capital cost, the operating cost, or the sustaining capital costs. You just get the money. Your gross becomes your net. From a general administrative cost perspective, too, operating gold mines is more expensive than not operating gold mines. Companies like Barrick and Newmont have huge staffs of geologists, engineers, accountants, stuff like that. The royalty and streaming companies don't have to have that because they don't operate things. So they're cheaper to operate. They're better businesses. And they're not sort of better businesses. They're way better businesses. That's important. The second point that you made is important too, which is to say when Bay Street and Wall Street look at the streaming companies in particular, they see a business that grew over 30 years on large transactions, and they believe that the large transactions are over, and that's wrong. The large transactions are increasing, and I'll tell you why. Gold and silver cash flow in a royalty or streaming wrapper trades in the market at 14 or 15 times cash flow. Base metals cash flow as part of a producing company changes hands at 5 or 6 times cash flow. What that means is that the gold and silver byproduct from a copper mine is best owned by a royalty and streaming company. A royalty and streaming company can pay a disproportionate amount for that portion of the mine's revenue that comes from gold and silver rather relative to copper. The copper industry estimates, and I just heard this number in London, it surprised me. The copper industry estimates that they will need to spend $250 billion in the next 10 years to maintain current production in a market where demand is increasing at 3% compounded. They're not talking about keeping up with demand. They're talking about maintaining current production. $250 billion. Now, the industry would appear to be, in terms of their access to free cash and credit, about $100 billion short. Where will that money come from? Lenders and streaming companies. The transactions that you will see in the future, building off out $7 or $8 billion porphyries, will mean that there will be an equity stack. Equity is part of the capital stack. There will likely be offtake capital contribution. There will likely be conventional debt. There will likely be subordinated debt, and there will almost certainly be a stream. And these transactions, the sale of precious metals byproduct streams from copper mining development, means that there are literally tens of billions of dollars of opportunity available to the precious metal streaming community from copper construction activities alone. The second facet of growth will be the consolidation of the mining industry and the precious metals mining industry. We're going to see a wave of M&A, billions and billions and billions of dollars of M&A. The cheapest form of quasi-equity is in a streaming space. And you will see, as you recently saw in the transaction where Hemlo was bought from Barrick, an important component of the compensation of the buyer to the seller will be accomplished by way of a stream. The third area of growth will be resource nationalism. Countries around the world would like to own larger parts of the producing assets within their countries. But many of the countries who desire these larger stakes don't have any money. They're precluded, often, but not always, by international convention from stealing those interests, so they have to buy them, but they don't have any money. How do they do that? Well, I suspect in the future, increasingly, there will be an accord between the company having the asset and the country that wants to own part of it, where the divesting company will finance the national interest partially by way of the sale of a stream. So in those three circumstances, the financing of base metals projects, private sector M&A, and public sector M&A, I think that the opportunities available to the streaming industry dwarf the opportunities that we've seen over the last 30 years.
So let's go ahead and go through some companies, and I just want to get your idea for your rankings. You rank a lot of portfolios and such, and so you all be sure to submit your portfolios to Rick at ruleinvestmentmedia.com so that he can rank your portfolio. He's done thousands of rankings, and so let's start with some of the tier one companies. So I want to get your ranking on Franco, Wheaton, and Royal Gold.
For the record, today's interview is taking place on the 17th of December. I say that because rankings are ephemeral. They're a snapshot in time. Something could happen in the news 4 weeks from now that completely obviate my ranking. So don't watch this discussion in June of 2026 and think that the ranking is current. Now let's get back to the question. Franco-Nevada is the best of the best, the finest precious metals investment on the planet. Despite the fact that it's done extremely well, I have it as a 4. Rankings are 1 to 10, 1 being best, 10 being worst. For the record, I've granted 11 number 1 rankings in 35 years of ranking stocks. A one ranking is extremely rare. Wheaton, I also have as a 4. Very, very, very high quality company. No longer silver centric, but still about 40% of its revenues silver related, which means that the financial results in the future, given the doubling of the silver price over the last 12 months, will surprise people whose expectation is rooted in the past. What were the other names? I'm sorry, Daryl.
Royal Gold.
Royal Gold, I just upgraded to 4. It has sold off a bit as a consequence of the Sandstorm acquisition, which I believe was a good acquisition. My hesitancy around Royal Gold used to be the concentration of the company on a very few assets and the weakness in its midstream growth. It obviated both of those concerns with their recent transaction, so I have it as a 4 as well.
Okay. So obviously the risks are a lot different for these companies. These companies are, multi-billion-dollar companies. They're the biggest and the best. Let's go down another tier. Let's talk triple flag.
I have triple flag as a 4 with a temptation to upgrade it as a 3 as a consequence of price performance. Triple flag is what I would call a mini major. There's a tier of companies below the majors. Triple flag is at that space. Much more systemic risk than the big companies because they have fewer tier one assets, which means that their revenues are unstable. It also means that it's easier to grow them, and they're selling at lesser multiples. I have triple flag as a 4. I'm very positively inclined to triple flag, and I've been adding it to my own personal portfolio.
Okay. Then we have Aura royalties, formerly known as a Cisco royalties.
Uh, Probably on fundamentals, the cheapest of the majors. Two tier one deposits, which means that you don't have the same reliance on tier two or three or tier three deposits. Also, what looked expensive but turned out to be a relatively fortuitous acquisition of the royalty portfolio of Orion, which is to say, at the point in time that they bought it, they paid a very full price. Then the gold price doubled
Hmm.
and made that acquisition look much more attractive. Again, I have it as a 4.
Yeah, yes, it's hard to get past the 4. So triple flag is the only one that's potentially going to be upgraded to 3. Just depends.
Listen, if the prices of any of them get weak, understand that this is a function of price to value. If
Yeah,
the price goes down, which scares people, it excites me. A
yeah,
bear market is a sale. It would be easy in market weakness to see this whole sector upgraded to a 3.